Hi, everyone. Good afternoon, ladies and gentlemen. Welcome to this session about currency crisis and debt crisis. As you all know, after the COVID-19, governments all over the world has pursued unprecedented fiscal stimulus, and this involves significant sovereign debt. A lot of countries borrowed heavily from the international market. And for the emerging markets, they not only have to borrow, but they also have to borrow in foreign currency, mostly in US dollar. So when the local currency is stable, things seems to be okay. But look at in the past few years, currency, especially those in the emerging market, has depreciated significantly relative to the US dollar. So how will this affect these governments' debt burdens? So when you are earning in your local currency but have to pay in US dollar or the other currency denominated not in your cash flows currency, that means that you have significantly exposed to the local currency depreciation. And this could be very, very risky when you are borrowing significantly in foreign currency. And this so-called currency mismatch risk is actually the major driver of the 1997 Latin American crisis and the 1997 Asia financial crisis and the 1994 Latin American crisis. And will these things happen again, or how will government deal with rising debt among rising currency volatility? In this session, we are very honored to invite several experts in this area. So please allow me to spare a few minutes to introduce our distinguished speaker. So our first speaker is Alfred Schipk. And Alfred is the director of the East Asia Institute. And he is also the professor of practice of international finance in the Lee Kuan Yew School of Public Policy here in the US. So before joining NUS, Alfred was the director of the IMF Singapore Regional Training Institute for Asia and Pacific. He's also an expert in China. He has been the representative of IMF in China for many years. And during his duty there, he has provided policy advice coordinating capacity development. He has also taught international finance in Harvard Kennedy School and National School of Development at Peking University. Our next speaker is Prakash Kannan. And for those who are learning about macros, especially those who are trading currencies or looking into international macro, this is a name that you shouldn't have missed. For those who are expert in trading this, I think his outlook and his comments on this global macroeconomic outlook is must-seen before you actually formulate any insight for currency trading. So he is the director of economics and investment strategy. He is also the managing director and chief economist in GIC. In GIC, he's responsible for global macro and asset allocation strategy. He's a renowned expert in currency risk management. So for a lot of trading strategy, I learned from my trader friends. He is one of the best in town. I'm not sure whether he's also one of the best globally. So other than being a top player in the investment, he is also He's also publishing a lot, surprisingly, in international finance leading journals, like Journal of International Money and Finance. So Prakash is a doctor in Stanford University. He has done significant research in currency risk management. Okay, now I can move to the third speaker, Ding Shen. Ding Shen, maybe some of the students here are already familiar with Ding Shen. So Ding Shen is the head of Labor Market and Research Division from Monetary Authority of Singapore. He coordinates and oversees economic research to support monetary policy decisions here in Singapore. He has done many interesting research on credit market, exchange rates, and the relation between labor market policies and macroeconomic outcomes. He also visited various places, including the U.S. Department of Finance and Federal Reserve Board, and he's also guest speaking in a lot of our lectures here. So without further ado, please join me to invite these three speakers. So now I would like to first invite Alfred to share his insight on debt crisis. Alfred, please.
Thank you very much, Juan. Real pleasure to be here. A very exciting topic. There are two things that are on many people's mind. One is, of course, China. China has one particular challenge, and that is the debt levels of local governments. And I wanted to talk a little bit about that. And the other one is that here, the Festival of Ideas, to think how basically international experience can potentially guide countries to avoid mistakes that have been made somewhere else. So what I'm trying to do is today to convince you that there is a similarity between China and some of the challenges that China faces in terms of its local government debt and the European Union. Now, some of you might say, well, that's a pretty far stretch. But I hope I can convince you that it is actually not. So let's think about what is the European Union, or more precisely, the European Monetary Union, right? You have one currency. Currently, you have 20 countries that have the same currency. And each country, though, has its own fiscal policy. It's relatively independent, right? Secondly, if you think a little bit about the size of each country in the European Union, well, it's almost identical to that of the size of provinces in China. Guangdong, 128 million people. What is the largest country in Europe? Germany, I don't know how much they are, about 83 million. And then you have very small provinces. Tibet is the smallest, I think 3.6 million people. And you have Malta in Europe. So size-wise, in terms of population, very similar. Now, somebody could say, well, how about economic terms? Well, Europe is very diverse, and China is very diverse. You have some provinces or province-level cities, like Beijing, that are relatively wealthy in terms of per capita income, and then you have others that are poorer. Same thing in Europe, where you have countries like Luxembourg, high per capita income, and then you have countries like Greece. Now, of course, one can stretch the similarities only so far. There are, of course, some differences. The central government in China is a lot more powerful than the European Commission in Europe. And if you actually look at the fiscal position, there are many, many similarities. First of all, China is actually very conservative in terms of its own fiscal policy. And I'm talking about the Ministry of Finance in China. It actually has a debt ceiling of 3% of GDP. That is the same measure that the European Union uses as a yardstick, right? So that's a ceiling. Then, of course, has local governments. And local governments, as you know, formally they're not allowed to borrow unless they have the authority from the central government. But it turns out, just like in the European Union, local governments are relatively fiscally independent. And that is, they basically go out and borrow. So let's suppose China is hit by a shock that does not hit all the provinces at the same time. So just like in the European Monetary Union, you only have one currency. So monetary policy is somewhat constrained to provide support, very similar to Europe. Now, when provinces then get into difficulties, why doesn't the central government? Well, just like in Europe, the central government is very cautious because it is concerned about what? Moral hazard. We provide them with financial support, but we can't really control them. So maybe tomorrow they continue executing what they did before. So very, very reluctant. And the fact that the central government has only limited abilities to control them is even reflected in how many people do you think at the Ministry of Finance in Beijing are in charge of local governments? Less than 10. That is for the entire country to monitor, to be on top. So you can imagine that it's very, very difficult. So what happened in Europe? And the comparison that I'm trying to make is going back to a crisis that Europe had in 2010. It was the Euro crisis, when some of the weaker countries in the European Monetary Union ran into fiscal difficulties. They had borrowed a lot, their debt levels were very high, and they were unable to borrow more. So Greece in 2010 had a debt to GDP ratio of 150%. You had other countries like Spain and Portugal that also had difficulties. Now, a picture tells 1,000 words, and this is basically the only figure that I wanted to show you, but it's remarkable. So what you see on the left-hand side is the European Monetary Union, or the European Union, the different countries, and the debt levels in 2010. You see at the very top, Greece in 2010 had debt levels of 150%. That actually increased to almost 180% in 2011. And then you see that there are other countries, some of them have very, very low debt levels. On the right-hand side, that's China. And just because they knew I'm going to give this presentation, they literally said, I'm going to make it identical. The debt to GDP ratio in Guizhou at the end of 23 was what? 150%. Identical to that of Greece. So similar to the problems that Europe had, China now has provinces that have high debt levels, that have difficulties in financing themselves. And what do? And again, here now, it is helpful to look at what is it that the Europeans did and what is it that we don't want to do where they made mistakes. So one of the mistakes that the Europeans made when they were facing the Greek crisis, they said, Greece, you need to do debt control. You need to cut spending, fiscal consolidation. And the Greek, of course, went ahead, cut spending, but without spending too much time to think about what does that mean to economic growth. Because there are many ways to cut spending, right? You ought to be cutting spending that is least adversely impacting economic growth. So what happened is Greece tightened the fiscal, and the debt to GDP ratio went up rather than down because the economy was suffering even further. So the challenge now in China is, as everybody is focusing on debt control, you also have to think about what will be the implications on growth, because if not, you're potentially cutting spending in the wrong places that then has adverse implications for growth. At the same time, when you do fiscal consolidation, and of course you have to do that, you have to think about other measures. How can I stimulate economic activity? Now, some of the things might just have to do with removing barriers, facilitating investments, but there might even be some room for additional investments, even in a very tight environment. The other one is, when local governments have debt levels, you have to restructure those. But how do you do that? You have to do it in a way that ultimately reduces the burden for those local government financing vehicles. Now, one thing that we have learned from Greece is, and the same thing is true in China, why is it that local governments have high debt levels? Well, in a certain aspect, they actually borrowed to build commercially viable hotels, congress halls that could very well be run by the private sector. So why don't you just sell those assets back to the private sector, monetize the resources, and reduce your gross debt levels. Of course, who did the lending to local government financing vehicles? Among others, the banking sector. And again, an important lesson from Greece is that when you now impose a hardship on banks because they have to accept NPV reductions, that ultimately means that the banking sector can be impacted. Now, the good news is that China's banking system as a whole is relatively resilient, so not too much concern. But as you can imagine, they're careful not to adversely impact that. And then there were 2 or 3 other things that don't seem to be that important from a macro perspective, but very important at the operational level, and that is capacity and communication. You can imagine that at the local level in China, capacity is limited. It is not what you have in Beijing. Some of the weaker provinces, government officials, they might not always have the right tools at their disposal. So helping them to deal with some of these issues in terms of capacity building is very important. And the other one that the first Greek program also did not do very well was communication. Obviously, some of the provinces are undergoing important adjustments right now that are painful. Therefore, it is so important to communicate what will be the light at the end of the tunnel. Because even if people see that there are some painful adjustments, but if you can see the light at the end of the tunnel, that gives you some confidence. If not, that undermines confidence, people save more, that has adverse implication for consumption, and therefore it further undermines the economy. So when it comes to communication, these are some of the things that have already been articulated in the third plenum, where the government articulates what it wants to do, especially as it relates to local governments, put them on sound fiscal footing, maybe transferring some of the spending obligation to the central government. The question, of course, now is how is this being implemented as that information becomes available? It's very, very important for households, local governments, companies, and the international community to have an understanding of how are we going to get to this adjusted economy. So the point that I was trying to make is it is sometimes helpful to look at experiences of other countries that might guide you in order to avoid the mistakes that were made before. My argument here is that when it comes to local governments, it is incredibly similar to what we saw in Europe in 2010. So therefore, it might be very helpful to learn from the lesson to avoid any crisis could have broader implications. Thank you very much.
Thank you very much, Alfred. It's a really interesting angle to compare China's debt crisis driven a lot by local governments with that in the EU system. Before we proceed to the panel discussion, please join me to welcome Prakash to talk about the currency crisis. Please.
Thanks, Hon-Hwan, and also thanks for a very generous introduction. I hope I don't disappoint people relative to the high expectations. So for today, I'm going to take the theme for this whole session, the Festival of Ideas, quite seriously, so that I'm going to maybe throw out some ideas, and I think lots of students, faculty, etc. here that where I think perhaps future areas of research could be warranted. There are going to be basically 2 main points that I'm going to make. The first is, when we think about currency crisis, I like to argue that I think the nature of currency crisis, particularly for emerging markets, has changed. and I'll talk about some of the reasons why I think they have changed. And then the second main point is that whether we think that we are entering a period where how we usually think about emerging markets, the sense of vulnerability, boom-bust cycles, etc., may also have changed, right? And there's a greater sense of resiliency. So let me get to the whenever we think about currency crisis, right? So these are kind of like binary events, if you will, right? A lot of you who do research on these kind of events, whether you're running like low-bit models, pro-bit models, etc., you need to find a way to define an event, right? So if we go back, I think it was Frankel and Rose, maybe in 1996, just after the Mexican peso crisis, they came up with a definition of, currency needs to fall by 25%. And that was, where you put a little one in your spreadsheet to say like, okay, this period, this country, this currency, that was a crisis. But you fast forward to today, and you're kind of seeing a very different evolution of crisis. So I've got two charts here. I don't know if it's visible that much from the crowd, but the first one on the left-hand side is the Brazilian real. Now the Brazilian real fell 61%, but the difference is that it fell 61% over 4 years, right? So kind of a very kind of gradual decline. And then the second one I have on the right-hand side is the Malaysian ringgit. Once again, 32%, and that too over 3 years. Now, if you go back, I'm sure a lot of you were around during this period. It never occurred that actually, hey, there was a currency crisis in Brazil. Hey, there was a currency crisis in our neighbor up north, right? And the reason for that is, the kind of secondary definition of a currency crisis in Frankel and Rose, some of the work by Carmen Reinhardt, was not just the magnitude, but also the speed, right? There was a certain kind of swiftness to the event. But my argument here is that something to think about is that actually what's playing out nowadays in emerging markets is still a very large kind of depreciation episodes, but just that they're spread out over a very long time. Now, why is that the case? So a few reasons. One is that emerging markets actually have been able to do a lot more counter-cyclical policy during recent crisis episodes. If you look at the chart on the bottom here, it's got two lines. The darker line is basically it's a financial conditions index. So every time that dark blue line goes up, it means that the economy is facing tighter financial conditions, so some form of stress. And then the light blue line is actually the policy rate, right? And then the 4 bars that have been shaded here are just kind of global events. So if you look all the way on the left-hand side, you see the global financial crisis, right? Big tightening of financial conditions in this part of the world. And what did, here is a sample of Asian central banks. What did Asian central banks do? They tightened, right? So you actually tighten policy during a crisis. If you look at the next episode, in a way synergizing with what Alfred was talking about earlier, this is the 2010 Euro debt crisis. Same thing. You had a tightening in financial conditions. What did policymakers do? They actually tightened, right? So they actually ended up running pro-cyclical policy in these first 2 periods. But if you fast forward to the 2 more recent periods, one is the 2015 period. So that is the period where actually oil prices fell very substantially. This is just after the big kind of fracking boom in the US, big supply by the Saudis, and also actually the devaluation in the renminbi. So you see financial conditions tighten, but actually a lot of EM, Asian central banks, cut rates, right? And similarly, once again, in the COVID episode, as you had financial conditions tightening because equity markets, etc., fell, EM central banks cut rates, right? So it's a very different approach, policy response in the last 2 episodes relative to what we saw before. So this, in a way, has led a little bit of a change in the mindset. So one of the famous papers that was written in the late 90s, early 2000s was a paper by Guillermo Calvo and Carmen Reinhardt, and the title of the paper is called Fear of Floating. right? So the fear of floating paper basically stated that even though countries stated that their currencies were floating, actually in practice they were very fixed, right? Because the policymakers were very scared of large currency mismatches running around in the economy, that they did not want too much fluctuations in the exchange rate. What this has shown is actually at the margin, you're seeing kind of a diminished kind of fear of floating phenomenon. And this is important because in EMs, typically, exchange rates are seen as an amplifier of shocks, right? So when you have a bad time, actually exchange rates depreciate, and that actually makes the macro situation a lot worse. But we could be moving towards a world where actually exchange rates are an absorber of shocks, right? So if you think about it, when you're facing hard times from a macro perspective, actually you want your currency to depreciate, right? You want your exports to be cheaper relative to the rest of the world, so to kind of boost external demand when domestic demand is under stress. So that is a very potentially a very big change from the past. Now, of course, policymakers always care about the volatility of rates, but they are more willing to allow larger depreciation. But this has not been kind of without cost. And I think Juan mentioned this at the start, that effectively what has happened is that the burden of depreciation has gone from the borrower to the lender, right? So if countries are able to withstand larger depreciations during bad times, they are willing to let their currency depreciate. But this means that for a foreign investor, actually your total return and still ends up taking a hit. Now there's this important paper which was, it came out in 2023, but they updated it in 2024 by Bertol, Bruno, and Shin. And they come up with this new term called the original sin redux. Now, what is the original sin redux? Actually, it's maybe it only comes up later, but basically the original sin redux is saying that in the past, the biggest problem for emerging markets and what they call the original sin was the inability to borrow money in your own currency. Right? So the original sin was always that if you wanted to borrow money, particularly from foreign agents, you had to issue debt in a foreign currency. And that's because your own macroeconomic policy, whether it's inflation, whether it's policy stability, was not credible enough, and so you needed the credibility of a hard currency. That has changed, and I'll show you a chart in a little bit how that has changed. But what Hyun Shin and his co-authors have shown is that the problem now is that because emerging markets can allow currencies to depreciate a lot, that foreign investors get nervous every time there's bad developments. Because there's bad developments, they say, okay, you're going to depreciate your currency, that's going to hit my returns, I'm going to take my money out sooner. So you still get that kind of pro-cyclical kind of capital flows, but it's just in a different form. So what explains this kind of slow moves, right? As I mentioned, you're not getting those sharp episodes, but you're getting kind of a more gradual. The key thing I want to highlight here is that actually the nature of EM crises, in a way, crises in quotation marks, over the last 10 years has actually been a really massive growth crisis, right? So what I've shown here is basically an EM-DM GDP growth differential. I've stripped out China from EM because if you know the trend growth in China has been coming down. So given that it's a large country and the trend growth is coming down, that would kind of color the analysis, but I've taken that out. And you can see that there was this kind of golden period between 2000 and 2010 where emerging markets were growing about 3-4 percentage points faster than developed markets. After 2010, you can see actually that growth rate started falling, right? So, a lot of people talk about, secular stagnation, et cetera, in the developed market space. Actually, I would argue that there was a big kind of secular stagnation, a really prolonged period of weak growth in emerging markets that has been less appreciated. Both Alfred and I used to be with the IMF, so not to insult the IMF forecasts, but all those squiggly lines were the IMF forecasts. So every time IMF forecasters thought that EMs would recover relative to DMs, and that's failed. The only good news here is, I think if you see the post-COVID period, you've actually seen a rebound in EM growth, and I do think that's a positive sign. So do we have a more resilient EM, right? So this chart at the bottom left is precisely what I was telling you about. That shows EM debt issued by governments by currency, right? So if you look at the early period, 06, 07, there's just very, especially if you look at the right-hand side, you can see that foreign holdings was predominantly in foreign currency bonds. But then you fast forward to more recently, and you can see that actually that has flipped in quite a meaningful way. So you have actually greater issuance of local currency bonds, which means that countries are able to absorb exchange rate depreciations without that usual mismatch in terms of I need to pay someone in dollars, but my local currency has gone down. The other thing, of course, is that the reason why you kept getting a lot of these discontinuous moves in exchange rates is because we used to have a lot more fixed exchange rates. That, by and large, has also gone away. And then you see this chart on the right-hand side here that shows emerging market current account balances. So I think, as Juan was mentioning in the start, in the 90s, what led up to the Mexican peso crisis, the East Asian financial crisis, all of that was this combination of fixed exchange rate, but also actually large current account deficits. A lot of that has gone away. EMs in general are now running surplus, and I think that in general makes for more stable currencies. But challenges remain, right? And I think some of the challenges that we talked about, I think Alfred also mentioned with regards to China. But importantly, this issue of what Hyun Shin calls the original sin redux, I think, is an important element for capital flows. So that's my intervention. Just kind of putting it out there that actually how we want to think about emerging markets, I think, has fundamentally changed. These kinds of very digital process, like, is it a crisis, is it not a crisis? I think we have to change our way we define these certain events. I think you're likely to see these kind of prolonged growth crises rather than very acute episodes. And I think it's that second point, which is, in a way, it's less problematic for domestic investors, but you're passing the burden on to foreign investors. And given that EMs typically have very thin markets, that kind of volatility of capital flows will still be quite impactful. So I'll leave my comments here. Happy to take up Q&A later.
Thank you very much, Prakash, for the great insights on original sin redux and the latest development on currency and stagnation in EM. Now, please join me to invite Dr. Ng Ting Shen from MAS to share the perspective of currency and debt crisis management from Singapore perspective. Ting Shen, please.
Thank you, Juan, and thanks to the LKY School for inviting me to be part of this really distinguished panel. I think we've had two perspectives on emerging market issues. Alfred spoke about debt in China and sort of like as a conglomeration almost of emerging markets in China, where the conglomeration is one of provinces. And Prakash also talked about how maybe in the recent 10 or 15 years, exchange rate issues that emerging markets face are more reflective of economic fundamentals than these kinds of sudden stop speculative events, which might have been more characteristic of the 90s. So today I'm going to talk about Singapore a little bit. Singapore is, by most accounts, a developed economy, an advanced economy. But in some of the data that I'll show you, it acts a lot like an emerging market, or looks a lot like an emerging market. So again, first I'll start off with public debt. Some of these lines, I guess, let me see if I have a pointer here. No, I don't. But essentially, these show the ratio of public debt to GDP from 2014 to through the COVID period for a range of advanced economies and Singapore. You'll see that in the COVID period between 2020 and 2021, there was a sort of step up in the ratio of public debt to GDP, and this is, of course, we know, because governments went into significant primary deficits to provide fiscal stimulus to their economies during the COVID crisis, which led to an increase in the numerator, the public debt numerator. But the denominator, GDP, also declined during COVID, and the combination of that led to a very significant increase, 20 percentage point or so, increase in the public debt to GDP ratio of most advanced economies. We see that the dark blue line, which is Singapore, also saw that. And in Singapore, we know that fiscal stimulus was unprecedented, of an unprecedented size during COVID, and resulted in a drawing down of some of the large stock of reserves that Singapore has built up over the years. But I would argue that the dark blue line, which represents Singapore, does not actually have some of the same drivers or causes as some of the other advanced economies. So the continued increase in the public debt to GDP ratio actually looks a lot more like an emerging market, where public debt to GDP ratios have continued to rise after COVID. Why is this a bad thing, you might ask? And there's a long sort of line of research that says that the public debt to GDP ratio is a good indicator of how well a country is likely to do in growth terms. So there's a sort of series of papers by Rogoff and Reinhardt and their co-authors that show that maybe 90% of public debt to GDP is a threshold of sorts beyond which countries are at higher risk of crises, at higher risk of prolonged low growth. And Singapore has clearly passed this threshold. Now, for those of you who've been in Singapore for a while, you might find this quite surprising because Singapore has been known throughout its history for fiscal prudence. Right, so if the Singapore government is so fiscally prudent, why is the public debt to GDP ratio so high? So I'll put to you through this chart on the left that the Singapore government does not have high public debt because it needs to finance its fiscal expenditures, which is the usual story, the one I told about advanced economies before. It's written into law, in Singapore law, that most of the debt that the Singapore government issues cannot be used to finance expenditure. That is, it can borrow, but it cannot use the proceeds of that borrowing to spend on things it wants to buy, be it a bridge or MRT or, well, okay, those examples are pretty bad now, but it can't use them to finance CDC vouchers, for example. The vast majority of the Singapore government's stock of public debt cannot legally be used to finance expenditure. So where does it go? Prakash will know this very well. The largest bar, special Singapore government securities that represents debt that's issued by the Singapore government in exchange for the CPF proceeds. So the stock of savings of Singapore residents' CPF savings go to CPF. They're then swapped out for these bonds. CPF holds the bonds. The Singapore government gets the proceeds of the CPF. And thereafter, through a series of procedures, that stock of savings is then invested. And one of the main organizations that does this is GIC, obviously. But beyond the CPF, which is the enforced savings part of Singapore savings, you also have a range of other bond options that the Singapore government issues, but is then not allowed to use the proceeds for, including Singapore government securities. So the first three sets of bars you see on the left are all different types of Singapore government securities. So these are used to sort of supply a demand for savings or savings instruments that the Singapore population has. So this chart on the right shows the personal savings rate for Singapore compared with a range of other advanced economies. And Singapore has a very, very high personal savings rate. Part of this is because of the enforced savings from the CPF system, But that's not the whole story. So the other part of the story is that Singaporeans love to save, if you believe the macro data. They don't want to consume as much of what they're earning, and then they're putting a lot of their savings into, they're trying to find places to put their savings. If the Singapore government does not issue debt, where is this likely to go? So I'll show you, maybe I'll just keep here. So leave that as an open question. So if the Singapore government does not have bonds for the Singapore population to buy, where are those savings likely to go? Okay. So just a few characteristics of Singapore's approach to public debt. So this is all leading to the high public debt to GDP ratio that you saw on the first slide. So first you have these strict fiscal rules where the government cannot borrow to spend. It can only spend what it sort of draws in the form of tax revenues, as well as interest returns from its previous accumulated primary surpluses. So it has this fiscally prudent sort of system of laws that keeps it in place. It also has, in the CPF, a defined contribution pension system, which almost guarantees high savings rates. And for those of you who've been taking Econ 101, you know from the Solo Swan intuition that high savings rates lead to high GDP per capita in the steady state. So that's kind of the thinking behind it. But the Singapore government also issues bond in order to develop these domestic bond markets, and this is what I want to focus on. I'll talk a little bit more about what that does. It deepens financial markets, and also has important implications for currency management, which is what sort of I look at on a daily basis at MAS. So the fourth one, just as an aside, the Singapore government has recently made it possible for them to borrow to spend, but these are sort of circumscribed to a very small set of public investment projects that have long-term returns. So there's an intuition here that follows Ricardian equivalence for those of you who've taken Econ 101 again. So if the government spends now, Ricardian equivalence says it's going to have to raise taxes in the future, right? So the line of thinking here is that you can only borrow to spend on things that will generate returns for future generations, such that you don't have to raise taxes in the future. So that's the idea. So these are sort of four pillars of the Singapore government's approach to public debt. Now, remember I talked a little bit about savings rates here, high savings rates. If Singaporeans don't have a place to put their savings, where do those savings go? They go overseas. So this is a chart for gross capital outflows. These are net purchases of foreign assets by Singapore residents. And you'll see that the dark blue line, which is Singapore here again, has large and volatile outflows of capital. So these are Singapore residents' purchases of foreign assets. These could be equities, could be bonds, but they're located overseas. And what does this do? Just to sort of like spark a thought here. When there's large capital outflows and volatile capital outflows, what happens to the Singapore dollar? There's a depreciationary pressure whenever there's an increase in outflows, and the reverse when there's a large decline in outflows. Right? So there are these large and volatile capital flows that then have an implication on the currency. So what the Singapore government wants to do is to develop domestic bond markets, which then can help to mitigate the size of these outflows a little bit. Now quickly going on to inflows. So aside from large and volatile outflows of capital, Singapore also has large and volatile capital inflows. So again, you see the dark blue line, which is the gross inflows, net purchases of Singapore assets by foreign investors. Again, the line is much higher than the other lines. The dark blue line is much higher, and it's also much more volatile, which means that Singapore is an important financial center where there are large capital inflows that sort of that are very variable. So what are these? Just within the sort of balance of payments accounts, if you look at gross capital inflows, so liabilities, external liabilities, you'll see a section in it that says other investments. Is this other investments innocuous? Sounds innocuous, right? But it sort of drives much of the variation in the gross capital inflows for Singapore. And I sort of highlighted this gray band here, which is during the COVID period in about April 2020, where we had we saw a large, around magnitude of 2% of GDP of inflows through these other investments. And what were these? So these were inflows of banking deposits. So safe haven flows. Foreign investors who noted during COVID, April 2020, that financial markets internationally were very unsafe and looked for a safe place to put their assets or put their money. And these resulted in these large inflows for Singapore. And what does this do to the currency? Again, so like these large inflows of deposits results in a large increased demand for the Sing dollar, which then has an implication for currency. So how does this affect us as Singapore policymakers? So at the MAS, you might know that we use the exchange rate as our monetary policy instrument or intermediate target, right? So we don't use it to fix exchange rates, as you'll read about in many open macroeconomy textbooks. We use it as a macro policy tool in the same way that other central banks use their interest rates. So we use it to modulate inflation and also modulate the output gap. And we do that by varying the level and the slope of the Sing dollar relative to a basket of international currencies. So we have these domestic macro variables in mind when we're trying to formulate policy. But we have these financial variables or financial forces that are also trying to impact the Sing dollar at the same time. So we have these capital inflows that I talked about, and we have these capital outflows because Singaporeans save a lot. So we have deep financial markets and macro-prudential policies. Some of you might have heard of the ABSD, the additional buyer stamp duty, right? So the reason that the government often puts out when it tries to raise the ABSD, and now it's at 60% of the price of your property. When you buy a property, you have to pay 60% on top of it if you're a foreign investor. So that's what we think of as macro-prudential policies. And we use that lever when we think that domestic macro variables are being affected. In this case, house prices. If housing is becoming unaffordable for local residents because of the large demand for capital inflows, in this case for Singapore real estate assets, macro-prudential policies are used as a lever to try and modulate that. For capital outflows, again, so we have this huge or big, sort of much larger than expected public debt to GDP ratio that sort of characterizes the Singapore debt situation. But a lot of it is in creating these domestic bond markets. The Singapore government issues debt, Singapore government securities, so that Singaporeans can put their money in Singapore rather than move them outwards. Right, so these all kind of mitigate the pressures on the currency, so I have this lambda in red up here. Which basically says that in addition to this standard Taylor rule that we have, where the Sing dollar is used to help affect inflation and the output gap, we also have to look at currency volatility. And this again relates to what Prakash said earlier about how currencies in the last 15 years or so, volatility or the acute periods of acute volatility seems to have declined. And I think I'll put forward that I think emerging markets are also becoming sort of more aware of the disamenities that a volatile currency will do for you. And therefore, they've also implemented some policy levers in order to help reduce this, in addition to sort of international financial reasons. So just some observations. Singapore's high public debt to GDP ratio is not an indication of indebtedness in the usual sense, but it's kind of underpinned by Singapore's strategy to managing high public debt. And Singapore's debt and currency management frameworks are very, very strongly interlinked. So this sort of sense of capital outflows, also having currency effects, and Singapore's bond markets having an effect on currency pressures. These interlinkages are at the forefront of the minds of macro policymakers in Singapore constantly. And so exchange rate-based monetary policy, which is what the MAS wields, is supported by both fiscal and macro-prudential policy to mitigate currency volatility so as to ensure that the MAS is able to fulfill its price stability mandate to help reduce inflation. Yeah, so that's what I have. Looking forward to the discussion.
Thank you very much, Ding for sharing a very fresh perspective on Singapore's experience in managing debt and currency not like managing debt and currency risk. So may I ask the panel speakers here whether this experience by Singapore can be extended to those, say, in Greece or in China, or more generally in the global crisis management? Maybe you want to start with Alfred?
I think it would be very difficult to emulate Singapore on many levels. Is in a unique position. Of course, on the one hand, it has very, very strong institutions which underpin the credibility of the framework. Most emerging markets and developing countries are well known for having relatively weak institutions. I think that's maybe one of the key differences. At the end of the day, I think, as Prakash was highlighting, this move toward exchange rate flexibility in emerging markets, being able to borrow domestically, has been a key driver of the improvements of the situation in emerging markets combined with high reserves. But again, I think if the entire world were to have strong institutions, I think even under those circumstances, probably to emulate Singapore would be very, very difficult. And I think lastly, one of the strengths of Singapore, and you all know Singapore better than I do, is the coordination of fiscal and monetary policy, which underpins the whole framework. That also is very unique to other countries where that coordination is not as perfect.
Yeah, I agree with everything that Alfred said. Maybe a few things to add. I think one is we have to understand that at the heart of it is that Singapore is a surplus economy, right? And so on a net basis, it will have to be exporting capital. It's actually a big, I showed that chart on emerging market current account balances. This really flipped at the late 90s, early 2000s, right? And so this whole region, outside of Indonesia and India, all became very strong kind of current account surplus nations. Now the challenge with that, I think, in the past 2 years, is that typically surplus nations tend to have very low interest rates, right? Just because your savings rate is high. And so if you look around this part of the world, you had Malaysia with a policy rate that peaked at 3%. Even if you go to Thailand, Korea, Taiwan, you had this whole region which was actually a very low yielding region, which is very different from how you think about emerging markets in general, where there's always some kind of like risk premium relative to the kind of risk-free asset. And that, actually going back to this point about exchange rates, has really been weighing on currencies in this whole part of the world, right? So, why would you put your money in Thailand or Malaysia or et cetera, which was giving you 3% or slightly lower, when the US dollar was giving you 5.5%. And I think that phenomenon over the last 2 years, along with the fact that the biggest divergence was actually with Japan, really weighed on exchange rates. And I think that's changing, right? So the market right now has about 250 basis points of cuts between now and end of 2025. That is really going to shrink the interest rate gap between the US and EM Asia. So I think that was in the recent episode maybe one challenge for this region, in that actually you had a lot of savings. I think this was mentioned. You had a lot of surplus, and that pushed yields down. And so actually your exchange rate ended up taking a lot of the brunt of adjustment. But I think actually you are kind of entering a period conditional on the US achieving a soft landing and not going into a recession, that actually gives this region a lot more policy space in the kind of next 12 months or so.
2 cents also. Yeah, I think exactly what Prakash said. So Singapore is a surplus country and in more than one sense. So Singapore is a surplus country in the sense that it has a large stock of foreign reserves that has been built up from a history of accumulated primary surpluses on the fiscal side. So I think maybe I should sort of structure this as 2 legs. So the Singapore experience, I think, has two features that I should highlight. So firstly, it has fiscal discipline. It has fiscal discipline in the sense that we don't see public debt used for, or let's say fiscal expenditures ballooning every time there's a crisis, which is something that very much characterized Japan's experience for the past 30 years. So Japan, the government always knew, I think, even from the 90s onwards, that fiscal prudence was important. And this was reflected in Abenomics as well, his 3 arrows of aggressive monetary policy, but the second was fiscal consolidation. But even as Japan, in the intervening years between crises, tried to reduce its public debt, once the crisis happens, it sort of balloons again. And this is sort of an experience that I think characterizes emerging markets during COVID as well. So without that fiscal discipline that's sort of enshrined into law and maybe is facilitated by already having a history of fiscal surpluses, it's very, very difficult to achieve. So I think, that's one leg which I think, there needs to be a lot more international coordination, institutional pressure, maybe even from the fund, which I mean has consistently applied this kind of pressure, but it's hard. That's a hard thing to coordinate. Going back to what Alfred said about the central government in China trying to maintain fiscal prudence for all of China's provinces. So that's one leg which I think is difficult to achieve. The second leg, however, where Singapore has gained credibility such that the currency is not subject to speculative attacks whenever there's any sign of weakness in the macroeconomy, or let's say in the financial system. So that one, I think, is actually something that other countries can emulate and something that other countries have emulated. So, I mean, the emerging world has gone through a sort of cycle, a super cycle, if you will, of reserve accumulation. Accumulation of foreign reserves for the past 20 years, the point of which is to deter speculative attacks on the currency. And going back to what Prakash said about the incidence or frequency of currency attacks not being quite so high as it was in the 90s, I mean, the fact that several emerging markets have accumulated significant reserves must also, I think, probably play an important role. And in that sense, from a partial equilibrium standpoint, from a single small open economy standpoint, it's possible to emulate that feature of the Singapore framework. From a general equilibrium standpoint, where internal or external balances of all the world's nations have to add up, the world as a whole cannot go into external imbalance. It's hard to imagine that without that first mover advantage of a group of emerging markets already having accumulated significant reserves, that those who didn't get on the bandwagon from the 2000s onwards can then sort of catch up. But at least from a partial equilibrium standpoint, currency volatility, reducing currency volatility is something that I think can be emulated.
Very much for the sharing, and it looks like the one of necessary condition is the fiscal credibility, which takes so long to establish. So given the emergency of many countries high debt burden right now, is there any immediate solutions, especially, given the current situation, right? Fed is expected to cut the interest rate, like Prakash just pointed out, give them more fiscal space. And how will this alleviate the fiscal or the debt issues in the emerging markets? May I invite you to share your thoughts on this how will the Fed policy affect these fiscal issues, affect the currency valuations across emerging markets? Please, Alfred.
Maybe just to complete the whole picture about debt crises, there's another group of countries that we have not touched upon, and those are the less developed countries where we have currently almost 50% of all low-income countries that are faced with debt levels that are judged either currently in debt distress or being close to debt distress. Of course, the differences there is they're not part necessarily of global capital markets, but of course it generates a lot of difficulties. Coming to emerging markets, obviously the Fed policy in general, and I think the fact that inflationary pressures across the globe are on a downward path will of course facilitate that interest rates will be that countries can cut interest rates, and that of course helps very much on the fiscal side. And for emerging markets, I think Prakash already indicated that increase what we call the degrees of freedom for policy adjustments. So I think that's very welcome news. But I think it also highlights that in this world we are still a U.S. dollar-dominated world. What happens in the U.S. literally matters for every emerging markets. And while that paradigm exists, it is important to put in place the buffers that are needed, starting from the fiscal side, having strong fiscal frameworks, starting on the monetary policy side, having strong monetary policy frameworks, the credibility of policies in general. Because again, tomorrow the Fed policy and conditions in the U.S. Can change again. So you never want to hope that you only rely on what happens, but I think it's a positive development for many parts of the world, including China.
So will this be more domestic or international? Like how will this, for example, drive the capital flows into this emerging market because of the interest rate difference now shrink? Or domestic factors like inflation infecting away the debt might be a solution? What do you think about this? Over to you, Prakash.
Sure. Maybe I'll just add one point to what Alfred was saying about EM debt. Whenever you look at emerging markets from a fiscal side, you got to look at two important variables, right? Effectively, your cost of capital and your return on capital, right? So you can think about it basically as the difference between your interest rate and your growth rate. The idea here being that what you are paying for your marginal cost of debt, can that be more than compensated by, in a way, what you're getting in return, which is your growth rate. So this kind of R minus G differential. And historically in EMs, you always get these spikes in your cost of capital. And that always happens during bad times, right? So what I showed you just now, so the periods where G goes down and R goes up, and it's not that your stock of debt's bad, but it's actually that your financing at the margin increases. Now, what's good for this part of the world, as I mentioned earlier, is that actually interest rates are relatively low, and on the flip side, actually growth is relatively high. So you take a country like India. India bond rates fluctuate between 6.5 to 7.5%, right? Sounds high, but it is an economy that's growing at about 11% nominal growth rate on a trend basis, right? So once again, it's even though your cost of debt is high, your economy is growing at a much higher rate. But then you move to a country like Brazil, and Brazil actually has your R minus G going the opposite way around, right? So Brazil is an economy where trend growth rate on a real basis is about 2. So if we take inflation at 4, it's maybe about 6%. The nominal interest rate in Brazil is now 11. right? So it's one of those countries where you have R minus G going the wrong way around. And so you can see how the fiscal discussions in a lot of these economies tend to be very, very different because they care a lot about consolidation and they care a lot about the deficit flows. So I think that differential, I think, is one thing that's very important. And then the other thing, particularly in this part of the world, and Alfred knows China very well in this regard, is that the tax revenue as a share of GDP is very low, right? And so that scope to increase the kind of tax incidence, the kind of coverage, without necessarily raising the marginal tax, I think is another way of trying to get fiscal balances much better. Now I'm going to answer your question, which was, you have to remind me what exactly the question was.
This is a question I want to ask everyone about the so-called the money financing. Do you think inflating away the debt could be an option?
Oh, right.
Yeah.
I think we have to be very careful with that kind of concept of inflating away the debt because, it's this whole thing of, you can fool me once, but you can't really fool me twice. When you look at the kind of different ways in which government debts, you can actually get consolidation. You can get it by, as I said, the better R minus G, so kind of better growth, lower interest rates. At the extreme, of course, you can always default. That's one way of reducing your debt. But inflation actually only works if you have surprise inflation. So something like 2022 was a useful episode because in some sense, you kind of had nominal growth shooting up, but interest rates kind of taking a while to come back to follow them higher. But if it is expected inflation, by and large, that's going to be reflected in your cost of capital, and so interest rates are going to be higher. So it really is, I think, that kind of surprise element. And once again, this fool me once, fool me twice thing. If the government can kind of try and engineer inflationary episodes to try and bring down the debt levels, but over time, that's just going to boost your term premium on your debt, and the economy is going to operate on a higher interest rate level. This goes back to the example of Brazil I mentioned earlier. Part of the problem in Brazil and why interest rates are so high, number one, is the opposite of this part of the world, in that it's actually a very low saving economy. But importantly, it has very low credibility with regards to monetary policy. So Brazil was actually one of the first countries to raise rates in this cycle because inflation expectations started going up faster. And so when you have that kind of credibility problem, inflation expectations go up, that's not really going to help you on your public debt because your cost of borrowing actually also increases.
So I think just responding a little bit what Prakash said, there's actually some pretty famous economists who've started subscribing to this, I guess, notion that fiscal dominance has become more discernible even in advanced economies. I think Robert Barrow and Francesco Bianchi have a recent working paper that essentially says that the inflation that the U.S. saw in from 2022 onwards was a result of accommodative Federal Reserve policies that then led to inflation. So in a sense, that is, from their perspective, which is on the basis of long-run government budget constraints for the U.S. specifically, you needed that surprise inflation in 2022 and 2023 in order for the long-run government budget constraint to hold in the U.S. And I guess that's sort of one way you can generate surprise inflation.
Well, what you got to do actually, if you really wanted to engineer this, is you've got to let inflation go, but then you've got to have financial repression, right? So you've got to keep interest rates low and let inflation go, and then what's going to happen is that your currency is going to depreciate. So you can achieve this if you wanted to, and there are many historical episodes in the past where you have financial repression, and in fact, you could argue even in the post-World War II era, part of the consolidation of government debt was through financial repression. But
Yeah.
that's going to take an impact on your currency, and that's a whole different risk premium.
So I guess the U.S. can do that, but maybe not emerging markets is what is that
But
something?
this
you might say?
scenario Prakash just described perfectly fit China's current situation. If China were able to spur the inflation surprisingly, right? So, is there a possible solution for alleviating China's debt crisis? Given this context.
First of all, your question is very well taken. Empirically speaking, when you look at the fiscal consolidation that has taken place, what are the drivers of addressing fiscal overhang or debt overhang? It is actually true that a large component, looking backward, has actually been inflation. So it was not the fiscal adjustment, it was not debt default, it was actually inflation. But coming back to the point, that is backward-looking, forward-looking. It has to be surprise inflation. So I think as a recipe, I think I'd be careful. But I think there is another component that one should not forget, that there are institutional differences across countries that deal with the issue of tolerance of inflation. There are certain countries where even slight increases in inflation start leading to political economy constraints, where the parties that are in power start losing because they're being blamed for that. I think the last episode that we saw across the globe was slightly of an outlier because it was a global phenomenon, but you see significant differences. If you were to look at China, I think China's I sometimes, say something that might not be, politically correct. But I think China's not resistance, fear of inflation is actually very similar to Germany. Both societies don't really tolerate high rates of inflation. But having said that, in the current environment, obviously, having nominal GDP growth being higher than it is probably the way to go forward.
Yeah, that was actually going to be my counter to it. I mean, I think historically it's more strong nominal growth rather than just inflation per se. I think you saw it in even in the UK. The UK actually experienced one of the largest consolidations of public debt from the end of World War II all the way down to the mid-80s, when it reached actually like 25% of GDP. It was a phenomenal consolidation. But the UK economy was growing at a 10% nominal growth rate in that whole period. Yes, inflation was high, but growth was high as well. And I think that's that's kind of like the the desired outcome for everyone, right? I mean, in a way, the best way to reduce your debt burden is to grow out of it. But it's always easier said than done, I think, is the problem.
For discussion, I feel difficult to let it go. I still have many questions, like to hear the experts debating about it. But now I'd like to open up for Q&A. May I now invite our audience to throw in questions, please. Can you identify yourself?
Hello. I'm Joydeep from the Energy Studies Institute. So a very interesting discussion. And I am new to Singapore, so it has been a learning experience. So I have a very specific question, mainly related to Singapore's growth drivers and challenges in the future. So what I observe is 400% of Singapore's GDP is based on trade. So Singapore is highly dependent on exports basically. So how do you manage this? And how do you ensure that there is growth? Is it due to competitiveness, trade, or is it due to exchange rate? And what are the possible maybe challenges in the future that you could expect in the current scenario of low global growth and geopolitical tensions? And basically, what are the drivers of Singapore's growth, and how do you see them evolving in the future? Thanks.
Yeah, I guess maybe I'll start. I mean, as macroeconomists or growth economists, we usually start off from the supply side, right? So you might look at GDP from the expenditure perspective, where net exports is a component. But if you look at sort of from the supply side, you're looking at your factor inputs, whether you have a high sort of capital to labor ratio, how strong is your human capital growing, how well educated is your workforce, how innovative they are. Do you have a high rate of innovation and dynamism in your economy that sort of comes through in total factor product? Those are pretty stock answers, but if you do that kind of supply side decomposition of Singapore's growth, you'll see that capital accumulation is a big driver of Singapore's growth. And a lot of this is in manufacturing and what we call modern services. So services like finance, your consulting and other professional services in ICT, and or let's say the tech sector. And capital accumulation that's sort of that's concentrated or targeted at those sectors tend to generate high returns from a TFP, from a total factor productivity perspective, and also lends itself to strong competitiveness internationally. So if you have those tradable sectors, so all those sectors produce output that can be traded, and if you have good innovation, capital accumulation in those sectors, you become more competitive over time, and that sort of enabled Singapore to grow as quickly as it did. As policymakers, I think we're worried as well. Singapore's growth in GDP per capita has sort of defied gravity. When you look at Singapore grew at sort of 5% per year in the 2010s, real GDP growth. And this is, for a developed economy, that's a fair question to ask, is this sustainable? But going back to the supply side, I think that would be sort of something that at least you can tell from the data. It's capital, it's machines, it's IP, it's sort of tech, R&D, that then increases the competitiveness of the tradable sector.
Ding Xuan, now let's invite the second question. Yes, please.
Yeah. I want to ask the SG public debt. I understand that the SG public debt actually is higher than the public debt of the UK. From my understanding, is 160% for SG, and UK only 1999, something like that. Yeah. Do you agree?
Data. That's in the data. Yeah. Mm-hmm.
I think the key point was made was the difference between gross debt and net debt. So while Singapore has that high amount of gross debt, it also has assets. And if you add, so a lot of the charts that were shown, for example, Singapore, the special Singapore government securities, your reserve management government securities, all of those have an equivalent asset component that match them. So actually that was my point to say that actually Singapore on net is actually a creditor nation. So we actually run a very large net foreign asset position. So you have large gross levels of debt, but you have even larger asset. So on a net basis, actually we're a creditor. It's the same for Japan. Japan is still a net debtor, but when you take 220% of GDP, you've got to subtract actually a bit of a reserve balance as well.
Yeah, exactly. So I think the public debt to GDP ratio is a gross concept. It's not a good indicator. I think despite studies that have shown that public debt to GDP is sort of like a harbinger of sort of economic growth to come. But it's definitely not the be all. So just to add, I think so like Prakash said, Singapore is not only a net credit. So many of the statistics that were brought up, trade being 200% of GDP, public debt to GDP ratio being 160%. You have your gross capital inflows and outflows being multiple times GDP. So all these are sort of crazy numbers when you sort of try and compare Singapore internationally. But I think all that is a product of Singapore being such an open economy, high growth, open economy that's at the same time an international financial center. So you have all these sort of numbers that are kind of off the charts when you try and do cross-country comparisons. But I think it's important to keep that fundamental thought that Singapore is high growth, but very open, both from a financial and trade perspectives.
Thank you very much. The gentleman at the back, please. Can you
Hi.
please briefly introduce yourself?
Yeah, my name is Eng. I'm on my own. I think there was some documentary last year about the 3 branches of the Foreign Reserve of Singapore. They're very well done. So the actual figure is secret. But when I put everything together in the back of my mind, I get the feeling that we probably have the largest reserve in the whole world. Yes or no? The other thing I'd like to get a bit more enlightenment is DBS, for some reason, lost 30 billion in some sort of monetary measures to possibly do something, maybe defend the Singapore currency. How did that come about, and what happened in terms of funds that were transferred back or loaned back to DBS, and what sort of implications has that got for Singapore in the near future? Yep, that's it.
This is a very difficult question.
Yeah, no, I mean, I'm going to give you a non-answer. So yeah, you've got 3 reserve entities. You've got MAS, you've got Temasek, and you've got GIC. 2 of those are public data, but the third one is not. So obviously the sum you can't back out. I'm not sure about the DBS question. Maybe you meant MAS rather than
I'm sorry.
DBS?
Yeah, I think you're right. I was a bit sleepy. It's the MAS, not DBS. DBS is very well funded, especially the MAS. How, I mean, it was to do with the previous CEO, I think Ravi Menon, who came on TV and said that, very briefly, that they needed to put some money, serious money on their balance sheet, because they may have, or they probably have lost 30 billion in some sort of measure. Can you throw a bit more light into how that happened?
Yeah, so just to clarify, I think what you're referring to is the value of the net assets that were held by MAS on the balance sheet fell because of currency translation factors. So one thing that sort of characterizes the Singapore balance or MAS's net asset position is that we hold a lot of assets that are denominated in foreign currency. So when the Sing dollar appreciates relative to foreign currencies, the value of our assets falls. Does that make sense? Right? Because in Sing dollar terms, the value of those assets falls. So that's a simple sort of currency translation issue that actually doesn't have to do with quote-unquote cash flows that the MAS has to deal with. So that's sort of one set of issues. The reason why the Singapore dollar appreciated is, like I mentioned, MAS uses the exchange rate as its monetary policy instrument. In 2022, 2023, we experienced quite high inflation, highest inflation that we've seen for over a decade. And in order to reduce inflation, we had to appreciate the Sing dollar. So the Sing dollar gained in value, which then led to foreign assets held on the MAS balance sheet seeing a depreciation in value. So it was to maintain macro policy objectives that led to the sort of the reduction in the value of MAS's assets. Nothing to do with cash flows.
Nice example of how exchange rate matters and currency risk matter. In this case, it's not even risk. It's just a symbolization of nominal denomination. May we now have the last question? Liu Qing, please.
Yeah, thank you so much, Professor Zhen. My name is Liu Qing, PhD candidate at school. Just a quick question to Dr. Prakash. So you mentioned the original sin and the original sin redux, which basically says with incredible, or rather like not credible policy, and with credible policy that stimulate the economy, the investment in emerging market will suffer. So like, are we basically saying that on the crisis, emerging market is very uninvestable? And also you mentioned that the current situation is good for the local investors, but not good for the international investors. Looking at less from a exchange rate perspective, but to the growth perspective, how do you see this role and the prospect of the local financing markets across Southeast Asia?
Over to you, Prakash, please.
So I think every time a government borrows from kind of a non-resident or a foreigner who has as kind of his or her base currency something different than the currency of the government that's doing the borrowing, you will always have an exchange rate risk. I think what I was trying to say is that in the past, it was the emerging market governments that bore the brunt of the exchange rate risk, right? So they borrowed in dollars typically, but they lent in domestic currency. So every time there was a macroeconomic shock, like their ability, not just taking kind of credit risk domestically, but also kind of taking currency risk, that when your exchange rate depreciated, you still needed to pay the kind of fixed nominal value of some foreign currency. So the exchange rate burden was on the government side. Over the past few years, actually now that burden is shifted over to the foreigner. So the key point here is that actually the current the exchange rate risk hasn't gone away. It's just kind of shifted from the borrower to the lender. Now, what that means is that the old challenge of emerging markets, which is kind of very volatile capital flows, actually is still there. So even in this scenario of higher amount of local currency debt, etc., you still get high volatile capital flows, and usually when you have thin markets like you do in emerging markets, that still kind of creates volatility in your domestic financial conditions. The thing I was trying to say, which I think is the original sin redux, is just that in a way you could have scenarios where you actually exaggerate the volatility of capital flows, because when you see a shock coming and you know that actually governments are not going to raise rates and actually they're going to cut rates and let the currency depreciate, foreigners are going to pull money out even sooner, because they don't want the burden of exchange rate adjustment falling on them. So it's that kind of phenomenon which I think has kind of just changed the nature of that interaction between governments and borrowers. But look, I mean, in the last few years and even currently, foreign positioning in emerging markets is generally very low, and you saw that in the kind of mini turmoil we had in early August, where you had the yen exchange rate appreciating very sharply. You had the Nikkei falling by 12% in one day. By and large, actually, emerging markets outside of Mexican peso, Brazilian real actually did okay. And some part of it was just that actually the foreign positioning in this part of the world is actually been low. Now, if you do get that Fed kind of cutting interest rates and etc., and that interest rate gap normalizes, that could actually potentially send more money this way.
Thank you very much. Thank you very much for the audience. And I would also recommend you to read Alfred's recent policy note regarding the Chinese debt crisis. In China's case, it's less about this original sin redux because they mainly borrow in their local currency. This will serve as a good counterfactor for a lot of emerging economies. Without further ado, please join me to thank our distinguished speakers, and then for the insights on their currency and debt. Please join me to thank these speakers, please. And thank you very much again for taking your time to participate in this panel. I will hope to see you again.